While most of you were finishing your last-minute shopping or opening wine with your families on Christmas Eve, a silent execution was being carried out in the shadows of the global financial architecture. It didn't happen on the news. It didn't trigger a White House press briefing. Instead, it unfolded in the sterile, air-conditioned server rooms of the CME Group and the CFTC between the hours of 11:47 p.m. and 2:30 a.m. This wasn't a glitch, and it wasn't a coincidence. It was a surgical strike. 3 major regulatory shifts, massive margin hikes, and immediate position limits were dropped onto the silver market at the exact moment when every bank in the world was closed. If you've lived through 2008 or the sudden lockdowns of 2020, you should recognize the scent of this. It's the smell of a trap being sprung while the prey is distracted by sentiment. History shows us that when the referees change the rules of the game at midnight on a holiday, it's not because the system is functioning, it's because the system is breaking. This has happened before, and if you aren't looking at the pattern, you're not just a bystander, you're the collateral. For a man in his 40s, protecting your family's future often comes down to one thing: mobility. You need to know that your assets can move when you do. But what we saw on Christmas Eve was the intentional removal of that mobility. This is what I call the liquidity noose. By raising margin requirements by 75% at midnight, the regulators weren't just asking for more money. They were ensuring that most participants couldn't provide it. When the CME demands an extra $11,250 per contract, while your bank O's S-wire department is offline for the holidays, they aren't stabilizing the market. They are guaranteeing forced liquidation. This is a structural chokehold. It was designed to exploit the physical lag of our traditional banking system against the near instantaneous speed of digital mandates. Think of it as a fire exit being chained, shut from the outside, just as the smoke starts to rise. The objective is simple: force the small and mid-sized players to sell their positions at a massive discount, effectively transferring wealth back to the institutional shorts who were about to be incinerated by the rally to 100. They didn't beat the market. They simply froze the exits and took the keys. If you still believe the free market operates on supply and demand during a crisis, you are ignoring the very mechanics of how control is maintained. This isn't about silver prices, it's about who is allowed to survive the reset. History isn't a collection of random dates, it's a blueprint of human desperation. What we are witnessing today is a carbon copy of the May 2011 Silver Massacre. Back then, silver was screaming toward $50. It felt unstoppable. But in a span of just 9 days, the CME hiked margins 5 times, an 84% increase. The result? A 30% price collapse in a week. The system didn't change the value of silver, it simply changed the cost of holding the paper. This is the regulatory reset, and it's a pattern that goes back even further. Look at 1980 and the Hunt brothers. When the system realized it couldn't provide the physical metal to satisfy the demand, the comics changed the rules mid-game to liquidation-only trading. You could sell, but you couldn't buy. It was the financial equivalent of a one-way valve. Or consider 1933, when Executive Order 6102 criminalized the possession of gold. The pattern is always the same. When the physical reality of a hard asset threatens the stability of the paper currency, the authorities don't fix the currency. They penalize the asset. They use the cloak of volatility or emergency to justify what is, in reality, a confiscation of momentum. For a man trying to secure his family's 401k, the lesson is cold and clear. The rules are written for the house, and when the house starts losing, they rewrite the rules in the dark. These weren't accidents, they were precedents. While the headlines focus on the midnight raid, they are missing the most dangerous crack in the foundation: the total decoupling of reality from the screen. In 2011, the silver rally was fueled by cheap debt and retail leverage. When the margin hikes hit, the air escaped the balloon because the balloon was made of paper. But 2025 is fundamentally different. Today, the demand isn't coming from speculators in basements. It's coming from the procurement floors of companies like Samsung, Tesla, and First Solar. These entities don't care about the CME's margin requirements. They don't trade on margin. They buy with cash because they need the physical atoms to keep their assembly lines moving. The Christmas trap was designed to shake out the paper traders, but it has no power over a physical deficit of 1.1 billion ounces. We are seeing a historic divergence. In Shanghai, the physical premium is already screaming, trading dollars higher than the manipulated COMEX price. This is the schism. When the paper price drops due to forced liquidations, but the physical price stays flat or rises, it signals that the vaults are empty. The big banks are playing a game of musical chairs, but the industrial giants have already taken the chairs out of the room. For a man looking at his portfolio, the question is no longer, what is the price of silver? But is there any silver left to back the price? The institutions are losing control over the physical metal, and when that happens, the paper market becomes a house of cards waiting for a breeze. The reason most people, your neighbors, your coworkers, even your brother-in-law, will be wiped out by this isn't because they lack information. It's because of a psychological glitch called normalcy bias. As a man responsible for a household, you've been conditioned to believe that the system will always correct itself. You believe that the adults in the room won't let it all collapse. But history teaches us that the adults in the room are usually the ones busy loading the lifeboats for themselves while telling you to stay in your cabin. They rely on your belief in the status quo. While you are distracted by holiday headlines or minor political squabbles, the elite are watching the flow of physical collateral. They want you to feel that you are being irrational for questioning the midnight rule changes. They want you to think this is just a glitch in the matrix. By the time the average person realizes that the paper promises in their retirement account do not command the same value as physical reality, the window to act will have vanished. To be clear, the majority doesn't see this coming not because it's a secret, but because it's too uncomfortable to acknowledge. Staying calm isn't about ignoring the fire, it's about knowing exactly where the exits are before everyone else smells the smoke. You aren't being paranoid, you are being observant. And in a crisis, observation is the only thing that separates the prepared from the panicked. In this final stage of the pattern, time doesn't move linearly, it accelerates. What was measured in years now moves in months, and shortly it will be measured in hours. The reason January is the flashpoint isn't due to a calendar flip. It is due to the mathematical brutality of the gamma squeeze. Currently, there's a mountain of call options sitting at the $75 strike price, representing roughly 150 million ounces of silver. As the price drifts toward that level, the market makers who sold those options are forced by their own algorithms to buy futures to hedge their risk. This creates a feedback loop that no regulatory memo can stop. The more the price rises, the more they must buy, which pushes the price higher, forcing even more buying. The Christmas trap was a desperate attempt to break this loop before the January expiration. They needed to drive the price down to $60 to render those options worthless. But if the price stays above $70, the spring is still coiled. We are entering a window where the paper market simply does not have enough physical metal to deliver if those options are exercised. When the world realizes the whole paper gold and paper silver in their accounts can't be converted because the vaults are empty, the price won't just rise, it will gap. We aren't looking at a slow climb to $100, we are looking at a vertical adjustment. As a man who has built a life on logic and responsibility, you understand that history does not shout its warnings. It whispers them through the shifting of rules. This isn't about get rich quick. This is about the fundamental difference between owning a promise and owning a reality. The Christmas intervention has made one thing clear. In the modern financial system, if you don't have it in your physical possession or in a fully allocated vault with your name on it, you do not own it. You merely have a claim on it that can be revoked by a midnight memo. The institutions are signaling their weakness, not their strength. They are fighting a war against the periodic table with ink and paper, and the periodic table always wins in the end. This is not a call to panic buy or to dump your entire portfolio. It is a prompt for a self-audit. Look at your 401k, your IRA, and your cash reserves. Ask yourself, how much of this is dependent on the good faith of people who just tried to trap the market while you were eating dinner with your kids? You don't need a savior, you need a fortress built on assets that don't require a counterparty to exist. Whether it's physical silver, land, or skills, the goal is to be the person who holds the silver when the paper claims are being settled for pennies on the dollar. The pattern is completing itself. The only question left is which side of the ledger you will be on when the music stops. What happened on Christmas Eve with silver is merely a dress rehearsal for a much larger fracture. The regulators aren't just afraid of a metal price, they are terrified of what that price represents. The loss of confidence in the very paper that funds the empire. If the silver market can decouple, so can the bond market. If the rules can be changed at midnight for a commodity, they can be changed for your bank account, your access to credit, and the definition of your private property. The pattern of the Christmas trap is a diagnostic tool. It shows us that we are moving from the era of managed stability into the era of desperate intervention. But there's another layer to this one, involving the sovereign debt of the United States and a specific shift in how global central banks are treating the dollar. A shift that looks identical to the lead-up of the 1971 gold window closure. We will be diving into that invisible framework in our next analysis, because while the world is watching the silver spot price, the real collapse is happening in a place that almost no one is looking at yet. If you want to see the full picture before the blinds are drawn, stay observant. The music hasn't just slowed down, the chairs are starting to vanish.